On March 12th, for the first time in recorded financial history, all asset classes collapsed on the very same day. It didn't matter if you were in stocks, bonds, treasuries, gold, real estate, developed markets, emerging markets, everything tanked. Margin calls were flying, leverage parties were selling anything that wasn't nailed down, and people were stockpiling cash in anticipation of a state of emergency. As asset prices were collapsing, some panicked investors called me asking, "Why is my asset allocation not working? What am I doing wrong?" The question is perfectly legitimate, though there are only two answers to that question. Either your asset allocation is problematic, or your expectations from your asset allocation are out of whack. We addressed the former in a previous conversation, but the latter is worthy of elaboration, as there are three common misconceptions about asset allocation. The first misconception about asset allocation is that it could deliver a precise outcome. Finance is not physics, nor for that matter any science. It does not have rigid, immutable laws which lead to perfectly predictable and repeatable outcomes. In financial markets, sometimes wonderful assets get pummeled and inferior assets experience meteoric rises. Sometimes stocks and bonds are correlated and sometimes they are not. Sometimes real estate is diversifier and sometimes it's not. And as we saw the last 2 weeks, markets don't always replicate their past behaviors. All asset allocation decisions are probabilistic rather than deterministic. Asset allocation doesn't prevent short-term loss, it just reduces the long-term probability of it. There's an element of chaos, risk, and randomness in the markets that's just impossible to handicap. The second misconception about asset allocation is that it protects against every scenario. There are some things asset allocations cannot solve for. For example, nuclear war or regional war, the global collapse, complete collapse of the global economy, or environmental devastations and pandemics like we're experiencing today. Expecting your asset allocation to protect you from these is akin to expecting an umbrella to protect you from a tsunami. Occasionally, tsunamis come through, and in that very moment, everyone feels the pain. Prices collapse, everyone is a seller, and every asset is correlated. Though once the dust settles, it is usually those with a diversified stream of cash flows, with exposures to a diversified set of risks, and a healthy dose of liquidity, who are in the best position to both carry on and take advantage of the abundant opportunities in front of them. The third misconception about asset allocation is that there is an ideal asset allocation. Absolutely no such thing. If there was, everyone would utilize it. Thousands of financial products would be built around it, and then countless others would learn to arbitrage it. Just like no dating app could produce your perfect spouse, no computer program can engineer your perfect asset allocation. Optimal asset allocations don't just employ good rules of thumb and best practices. They also account for the idiosyncrasies of individual investors, their needs, concerns, constraints, aspirations, etc., giving them the staying power to make better investment decisions. So, for anyone that is questioning their asset allocation, consider whether it's your allocation or your expectation. And if you want to debate it, I'm stuck at home and happy to have the conversation. Till then, stay healthy, stay calm, and stay thoughtful.